Welcome in, folks. We got an action-packed day here today, and I got an action-packed video for you. 4 reactions up for you here today. Okay, first one up here. Tom Lee, everybody's favorite bull. Russell 2000 will see a 40% rally by the end of summer. By the end of summer. All right, we're already coming upon late July, so that's a big statement. Okie dokie. That should be interesting. UPS slides most in 15 years as earnings miss estimates. This stock is now down 45 percentage points from where it was to kind of start 2022. Incredible. So we'll speak about UPS, what's going on there. Google ends plans to eliminate cookies. I think this is important. Google's reporting after the bell, by the way. I don't think a lot of people are paying attention to this news. I think it actually matters significantly for Google's future numbers. And then last one up here, home sales fall more than expected, but prices hit new high. That has people feeling like a little bit of stagflation there, okay? Appreciate everybody joining me as always. Thanks so much for being here. Thank you for smashing a thumbs up. All you guys that do it, I appreciate y'all. And thank you to everybody that's subscribed here to the channel. Appreciate y'all, okay? Let's get into this.
Friday's inflation data will likely shift the odds higher of a July and September rate cut, supporting the summer of small caps, as he said. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors, Head of Research and a CNBC contributor. Tom, it's great to have you.
Great to see you.
You want to start with what the political news or the economic news? What's more important to you, do you think?
In the short term, it's the political news. But really, in the longer term, especially into year end, it's actually the economic news.
Explain why.
Well, in the short term, markets are very sensitive to, especially the sector level, depending on whether it's a Republican or Democratic taking the White House in November, and then especially all the congressional elections and state elections. So I think that's what you saw last week, is as probably shifted towards Trump, small caps, industrials, financials rally.
And you're sticking with that call, which is for what, 40% over 10 weeks?
Yeah, the overlap is small caps are very sensitive to a Fed cut, and really the probability of a Fed cut, that it's finally happening. And I think it's going to look like the October to December 2023 rally, which was almost 30%. This one should be bigger because of the amount of short positioning and the amount of oversold in the Russell. So, yeah, 40% by the end of the summer.
That's an insane prediction, first off. Absolutely insane. But we know Tom Lee makes a lot of insane predictions. And I would say most don't come true, but every once in a while, one does come true. Now, let's see if small caps are actually rolling here today. Okay, let's go ahead. Let's take a peek. Not the oil and gas stocks. No, I don't want to hit that button again. Come on, man. I'm going to this one. All right, let's take a look. What do we have? So let's look at the best stocks here today. ELF, not really a small cap anymore, although it sometimes gets grouped in there. So that one's doing well. It's my best stock here today, 6% plus gainer. The Planet's up about 4.6%. That's a micro cap, but that's on the back of Kamala hope, actually. And with B-Man not being in this election, the hope is from the MJ stock side, if Kamala was elected, that would be very bullish for those stocks potentially. We'll see. Fubo's up about 2% here today. Other than that, Revolve's up about 1%. SoFi is down very slightly. Honest is down very slightly. So not exactly a super bullish day for small caps. And the Russell's up a little less than 1%. So it's not that it's a bad day for small caps. It's just a decent day out there, but this is a crazy call.
Dig into it. Does it make sense that tech, that NVIDIA and Tesla and Microsoft and Apple and Meta should be outperforming as the odds rise for a Democratic victory?
Some of that, it's, day to day, it can be noise because last week you had the biggest down week for the NASDAQ in quite a long time. So I think there is a bit of a dead cat bounce. But to me, I agree with you. I don't think that the FANGs are necessarily a Kamala Harris, taking the White House trade.
But there is some evidence of the fading of the Trump trade, as you mentioned. Russell's underperforming, Bitcoin weaker today, financials are lower, so are energy stocks.
Well, again, it's, the sell-off for the Russell started in the middle of last week. It's down almost 5%. It is a mirror image of what happened in October. After that first week rally, you had a 5% decline over 8 trading days, and then you had essentially a 25% rally for 7 weeks without a drawdown. I'm not sure that's any different today.
Is your long-standing optimism about deflation really changing at all? Do you expect any surprises on Friday?
I mean, one print can be uncertain, but I think the forces underway for inflation to fall like a rock are in place. I mean, the reality is there's a durables recession. It's in housing, and now it's in autos. That's like 60% of the CPI basket is in a decline until the Fed really injects confidence by cutting. And so I think there is urgency for Fed cuts to happen sooner. But at the same time, I think the effect on inflation is there isn't another incremental driver for new inflation. So inflation, I think, is going to surprise to the downside, and hopefully it's Friday.
Energy, same story. I know we've got gasoline futures lowest in a few weeks, and we broke 80 today on WTI. Brent's below the 200-day.
Yeah, I think energy is a tough trade in the near term because as long as oil's under pressure, I'm not sure I want to be overweight energy stocks. And if there's drilling under Trump, that's downside pressure to oil. But over the next 3 to 5 years, I think energy is a great investment. But I think this year it's not really going to be the spotlight for us.
Interesting. So, do I think small caps will rally? The Russell's going to rally 40% by the end of summer? No. I wish that happens, but no. We got to be realistic about these things, right? And Tom Lee went into this year talking about 50, 60%. Small caps are going to rise, and obviously we're not even remotely close to that, right? I mean, the Russell this year, honestly, it's done okay. But I believe the Russell significantly underperformed the other indexes, just to be quite frank. Let's see a year to date. So the Russell's up 11%, right? And a lot of that's obviously come very recently here. I don't even think that's beating the S&P 500. I know it's not beating the NASDAQ. For sure not beating the NASDAQ, right? And then let's pull up the S&P 500 as well. So if we go ahead and take a peek here, yeah, the Russell's underperforming the S&P 500 significantly. It's underperforming the NASDAQ by a mile, right? So, yeah, Tom Lee, I think, is getting desperate for this insane rally to happen in small caps. And, certainly at some point in time, small caps are going to play a game of catch-up, and it's going to be fun. But, yeah, some of these calls he makes are just absolute insanity, man. 40% by the end of summer, 50, 60% this year, and here we are sitting at 11% for the year, significantly underperformed the S&P and Qs, right? It would have been, his call would have been better if he would have said the NASDAQ's going to be up that much, right? All right, next one up here, UPS slides most in 15 years as earnings miss estimates. It's an important video, important that we talk about this because we got to figure out, do we have a recession going on, or is this UPS specific? Because this is a very important company to look at if you want to know what's going on with the economy.
Worst day since October 2008. I know that they missed, but was it really that bad?
You never want to hear that. Worst day since October 2008? No bueno.
Well, I think the expectations going into the second quarter weren't great because everyone knew that there were a lot of headwinds facing the company, especially as it relates to its new labor agreement with the Teamsters, which anniversaries on August 1st. That being said, I think demand was not as good, and also UPS was apparently hit by a mix shift of lower yielding, lower profitable freight. They've definitely seen a trade down where someone that might have shipped something via air decided to go ground, and someone that was using ground, maybe they're using their SurePost, which is more of an economy type product. And all these products have lower yields, which definitely impacted the top line. I think sentiment is really low on UPS, which is the old saying, it's darkest before the dawn. I think looking into the second half of the year, there are a lot of things that could go UPS's way if demand comes along, and that's a big if. And as you were talking earlier, it's all about consumer demand and economic activity.
Lee, because there's such a big if baked in there.
Before we go further here, I do have some good news, a glimmer of hope in regards to the situation in regards to UPS. And I'm talking about it's a glimmer of hope. But check this out here. I found this, okay? I want to thank UPSers for their hard work and efforts in the second quarter, says the CEO of the company. This quarter was a significant turning point for our company as we return to volume growth in the United States for the first time in 9 quarters. I do think that's significant. I do think that matters, right? I mean, the fact that volumes were negative in the U.S. for basically 2 years, I mean, that's incredible, right? And it is a glimmer of hope, but you can't get too excited about that. What if volumes then go the other way again and then go back negative? It's only one quarter, but it is a good sign in regards to that. Now, UPS is also one of many companies that is caught up in this, I would call it, a lot of these famous stocks that are just doing horrible. And I'm going to actually add UPS to my potential buys watch list here, although I might not buy it. I'm still going to add it on there. I mean, it is a good company, right? Obviously, they have not had a very good last few years, but it is a good company overall. And it's usually a money maker over the long term, right? But so I'll add that one to my watch list here for my possible buys watch list. But, it's just one of many famous companies that are just doing absolutely horrible. There's so many of them, right? So many of them. Whirlpool would be another one. Nike would be another one, right? Celsius, they're not as famous, but certainly they would be another one. Estee Lauder would be another one. Starbucks would be another one. Sam Adams would be another one. Lululemon would be another one, right? A lot of these stocks that are just like, big name companies, famous, but man, and these are usually seen as very stable business models, but man, are they going through tough times in regards to their stock price. Absolutely brutal.
Do UPS's earnings say about everything else, given that they're such a bellwether here?
Well, the good news is that their domestic operations, which is really, in the U.S., has seen volume growth inflect positively for the first time in about 10 quarters.
I'll take my stuff, Lee.
That obviously to us is maybe telling us maybe the worst is over for them on the demand side. And then on their international side, they noted that a number of their markets were starting to see growth again, especially as it relates to Asia. And again, these are, incremental net positives. The company, also increased its confidence by reinstating their share purchase program. They're going to buy back around $500 million in the second half of the year and maybe $1 billion next year. That's obviously a step in the right direction. Some of that is driven by, their plans to divest their brokerage business, which is called Coyote. RXO is going to buy that business. It's supposed to close at the end of the year. And that is expected to free up some cash, which is they're probably using towards those buybacks. But the big kind of takeaway here is that margins are just not going to be as good as they originally thought, and some of that has to do with A, higher labor costs, and B, maybe the product mix is not where they thought it was going to be 3 or 6 months ago.
100%. Now let's see if 1000X on 1000X, right? Let's see if UPS is a good deal valuation-wise, okay? So what I want you to go ahead and take a look at. Now keep in mind, our market cap usually updates at midnight. So right now, UPS's market cap is likely under 110 billion as of right now, right? This was as of yesterday, the market cap, right? But if we go ahead and we take a peek at the forward P on the stock, 15 for it, right? That's, if you think about UPS, you think about a very stable company, that's not the craziest number, right? A 15 forward P. But at the same time, if it's a company that a lot of people do not really like or don't really want to invest into, you're probably stuck around a 15 long term. So if you're going to get a lot of appreciation in UPS, don't count on it coming from a valuation uptick. Likely count on it from multiple expansion, like PE expansion. You've got to count on it that their net income is going to get to a better place. Their earnings per share is going to get to a better place. So maybe the PE, they can always stay at a forward PE, but you can get nice share appreciation over the coming years and dividend increase and things like that, right? But, obviously this year is not exciting when it comes to earnings per share, not exciting when it comes to revenue. But next year, they're expected to get in a better place. Next year, expected earnings per share growth, analysts are at about 22% on average, about 6.5% for revenue growth on average from these analysts. So that's good. So, UPS, I would say UPS today is, I would say it's a buy. But the problem is there's so many other stocks that are also a buy in this market, right? And so that's the difficult thing where it's like everybody's got a finite amount of money. Do you put money into a UPS instead of put money into a million other opportunities in this market, right? There's a lot of opportunities in this market, right? If we go to the compare feature here on 1000X, and we pull up, let's pull up UPS versus some other stocks, right? We can pull up UPS. We'll pull them up versus, let's say, a stock like a Meta, right? Which Meta's gone up so much, but it's still very undervalued in my opinion. And let's also compare them against, who else do we want to compare them against? That might be a stock. Well, I like Nike right now, right? I'm buying Nike shares pretty much every chance I get right now, right? So if we want to, and I apologize, my internet's not the fastest today. My internet is not the fastest. There we go. Nike versus UPS, we're talking about a 15 forward P versus Nike's at 23, right? 2-year out forward P, 12 versus Nike's at about a 16. Meta's at about a 20, right? But look at the trailing 12-month earnings per share shrink in regards to UPS, 44%. Meta's up 121%. Nike's up 15%, right? Current year, 4% up for UPS, 38% up expected for Meta, and then around flattish for Nike, right? Next year, 22% expected for UPS, 15% for Meta, and about 27% for Nike, right? And then obviously the revenue is a big revenue shrink for UPS versus growth for Meta versus kind of flattish for Nike here. So when I kind of look at these sorts of companies versus each other, right? Obviously Nike trades at a much, or doesn't trade at it. It commands a much higher, they have much higher net margin than obviously UPS, right? But nothing compared to Meta. I mean, if I was to compare these, Meta's a better buy than either of these other stocks, right? With that being said, I've got personally so much money invested in Meta already that I'm good, which is why I focus on buying Nike. But if I didn't have a position, honestly, Meta's the best buy of these three. If I had no position in any of these three stocks, Meta's the best buy of them all. It just is. For a long-term investor. Short-term, anything can happen, but for a long-term, it's actually the best buy, right? So a little food for thought in regards to that, but what if we compared them to let's say like a Starbucks, right? And the other thing I like about, let's say, so Starbucks about 19 forward P versus 15 for UPS, 2-year out forward P 12 versus 17. I like UPS is a more commoditized business, unfortunately. Obviously they have to compete with the Postal Service, they have to compete with FedEx, they have to also compete with Amazon as well, right? I like companies like a Starbucks or even a Nike better because they're kind of their own thing, and it's very difficult to compete against those companies, right? It's virtually impossible to compete against Nike, and it's incredibly hard to compete against Starbucks because of the scale of those sorts of companies have. That it's just insane, and so you need a bigger player to come in to really shake things up. So with UPS, they have to deal with Amazon. That's a bigger player that's come in, and obviously what Amazon's built with their distribution network, what they built with their fleet of planes, right? What they built with their fleet of trucks. It's incredible what they've done there. So anyways, the moral of the story is UPS a buy, but there's better opportunities, honestly. There's a lot of opportunities in this market, man. You see how big my potential buys watch list is? That thing is deep right now. That thing is deep. Look at that. Look at how many potential buys I have on here. I mean, I got half the S&P 500 on there. Okay, it's not that extreme, but you see what I'm saying, right? Google McDougal, they're reporting after the bell, by the way. This should be an interesting one. They end their plans to eliminate cookies. This is important, actually.
Years of delay, Google says it will no longer cancel and replace third-party cookies. Yep. Cookies are a small piece of code that websites deliver to track a user's behavior. It sticks around as a person visits other sites, gathering information that has fueled the digital advertising market. Now, back in 2020, Google said it would end support for those cookies by early 2022, once it figured out how to address the needs of users and publishers and advertisers. Now the company says it's received feedback from both advertisers and regulators that led its decision to cancel the plan. Google says instead of eliminating third-party cookies, it would introduce a new experience in its Chrome browser that allows people to make what they're calling an informed choice that applies across their web browsing. It says it's discussing this new plan with regulators and would engage with the industry as it rolls out the software. But how many...
The politicians were like, listen, man, we need to market to these folks. We need to show them ads so we can get the votes. The politicians are probably the ones that stepped up behind closed doors there and were like, hey, we need the cookies on these people. We need to know. Do they own a gun? Do they not own a gun? We need to know all these things.
Have you got into some website and it says, Would you like to accept all cookies, no cookies, some First of all, I never hit the some cookies because I don't even understand which cookies I'm supposed to be. So it's usually just accept all and let's keep moving the train ahead of the game.
Right, because then if you say no, it takes you down the rabbit hole.
Sometimes then you're in a whole other world.
Yeah.
So what are we even talking about?
They ask for a lot of things. I usually say no.
You say no.
Location? Can we do this? Can we go across? Can we look at your stuff across all your stuff?
Oh, I say no on the apps for that. No, and you cannot not track where I'm going either.
Yeah.
Yeah.
Probably doesn't matter. They're doing it anyway, probably.
Probably how most American feel.
Oh yeah, they'll find. Yes. 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 Okay. Yeah, like there's ways around the system. That's all I'm going to say about that.
It's hopeless.
All right. Separately, Alphabet's talks to acquire cybersecurity startup Wiz for a planned $23 billion have fallen apart. The co-founder of Wiz told employees in a memo that it was tough to say no to such a humbling offer, but it would continue with its plans to pursue an IPO. A person familiar with Wiz's decision cited antitrust and investor concerns as part of the reason for abandoning that potential deal. There were a lot of questions about whether regulators would allow that to go through, just given how much focus there is on the big tech companies these days, and maybe that got...
I don't know why they were even worried, because nobody beats the Wiz.
Oh, showing your age. Do you remember the Wiz? The electronic store,
That's
folks.
why.
Yeah, so my opinion on that potential deal that was going to go through there, I think even more so than obviously the business case on this Wiz acquisition, which, by the way, that company's not even that old. It's only a few years old, and they were going to already buy them for $23 billion. I think it's Google trying to shake up that stock. Google stock has done pretty decent this year, but it's just if you look at it for the past like 2 years, it's underperformed a lot of the other big techs, so just in a quite a considerable way. And so I feel like that was a deal to kind of get people not as focused on everything they've been focused on in regards to Google and kind of get everybody's focus a little somewhere else. And so the fact that it's not likely going to happen now is I don't think a great thing for Google overall, right? Okay, let's get in this last one, home sales. By the way, if you're looking for access to 1000xstocks.com, I'll put that as a pinned comment down there today if you want to apply for access. We even got our education portion now. Have you guys seen this? Look at this. How to decode a balance sheet, how to decode an income statement, how to decode a cash flow statement, how to perform SWOT analysis, strong moat versus weak moat, how to value a dividend stock, how to value a growth stock, dividend investing, portfolio management. Oh man, it's beautiful. It's beautiful. I don't know if you guys have seen that yet, but anyways, that will be pinned comment down there to apply for that.
And for that, we'll get to Rick Santelli. Morning, Rick.
Good morning, Carl. Indeed, the weaker data continues. Earlier, we had Philly at minus 19.1, weakest month over month since December 2020. We now see Richmond Fed on the manufacturing index comes in for July at minus 17. That's the weakest going back 4 years plus to May of 2020. And if we look at the service side of the equation, it comes in at minus 9. That follows minus 11, which was now changed to and revised to minus 8, which means we haven't had a positive number on the service side of Richmond Fed going all the way back to August of last year. Now, if we look at interest rates, this is one of the reasons they remained a bit under pressure. But with this surprisingly weak data, it's a bit shocking they haven't rallied, pushing yields down farther. We also have existing home sales out, and for that, we go to Diana Olick. Diana?
Well, Rick, existing home sales in June dropped.
So not great when you get some of these different surveys and things like that coming out negative. When you already have concerns about going into recession, are you in recession, those sorts of things, it's even more concerning when you have it, not ideal.
5.4% from May to a seasonally adjusted annualized rate of 3.89 million units. That's lower than the street expected. Sales.
Who called this ahead of time? Man, if you watch my videos early this year, I told you guys it was going to be a cold winter and the spring was going to be bad for home sales. I saw what was going on with mortgage rates, and right there, I knew it was not going to be it, right? And sure enough, look at how disappointing home sales have been all of the winter, all of obviously the spring. It's been so disappointing. The sales have been awful.
Down 5.4% in June of last year, all according to the realtors. Now, these are closed sales, so based on contracts signed mostly in April.
A lot of realtors and a lot of folks in the real estate industry, they thought this was going to be a good spring. They were going to have up numbers on a year-over-year basis. And I was just like, no, that's not happening. And sure enough, yeah, you know, there's a difference between hoping and looking at the data and looking at the facts and deciphering what's actually going on.
When the average rate on the 30-year fix jumped above 7% and stayed there. Rates have pulled back slightly since then to the high 6% range now. Inventory bumped higher, up over 23% from a year ago, but still just a 4.1 month supply. That's because it's coming off record lows. 6 months is considered balance between buyer and seller. A lot of that is also that homes are sitting on the market longer, increasing supply. Average days 22, up from 18 days on the market a year ago. And even that new supply not helping ease prices. $426,900 was the median price of an existing home sold in June. That's up 4.1% year over year, and the second straight month at an all-time high. Remember, part of that is skewed toward what is actually selling, the median, and the higher end is what's selling. The $1 million plus range is the only one that is seeing stronger sales than a year ago. 28% of...
And you know why? Cash, baby. A lot of people that buy $1 million plus, they got the cash. Oh, they steal my stuff, man.
We're all cash. That's up from 26% a year ago. Sarah, good to be on the high end.
Yeah, even Toll Brothers called that out in their latest conference call. When I was listening to that, their latest conference call was like, I think 2 months ago or so. A month ago, 2 months ago. I think it was back in May, I want to say. But, you know, in Toll Brothers call, they were talking about, obviously they sell super high end, you know, the highest high end of any public home builder, right? Average sales price is $1 million plus. And they have a considerable amount of customers that buy all cash. And so they don't feel the effects of mortgage rates. It's like, okay, mortgage rates are high, who cares? If you're buying all cash, it's irrelevant to you. You're not worried about a payment, right? You're going to own it outright. So that's where you see this really like this major differentiation in the real estate market. But the problem is most people don't buy all cash, right? There's a very small amount of people that can afford to buy a home or are willing to buy a home all cash, right? It's the very top of the market. The problem is most people aren't at the top of the market. So in order to have a super healthy overall real estate market, right, you've got to have prices in check and you've got to have mortgage rates in check, right? And right now we don't have either. And that's why this housing market's going to continue to, in my opinion, get worse over the next bit of time, regardless of what happens in the economy. I think the housing market will continue to deteriorate for at least the next year, if not 2 years. Because we don't have mortgage rates where we need them, and we don't have home prices where we need them. We still need to get both those in check, and that's going to take some time, man. It all takes time, okay? All right, guys, appreciate you joining me as always. Busy day here, man. Got a lot of earnings coming after the bell. Appreciate y'all joining me. If you're looking to access 1000xstocks.com, you can check out the pinned comment down there. Click on that, fill out an application. We'll see if we can get you access to that. Much love and have a great day.